Partner Ramesh Iyer joins us now. Now, before we connect with Mr. Iyer, let me set the context here why we've invited him. And the reason why we've invited him is that we want to discuss the rural recovery. Has the rural recovery started? Is the worst over? And what about their 3-year ambitious plan of doubling the AUM? Mr. Iyer, fantastic to have you back. Thank you for joining us. You know, the rural economy in last 1 year, I would say, is more like a yes and a no economy. There are times when we get excited, but there are moments when we get worried. FMCG companies are telling me the rural demand is suffering. Your data point is telling me demand is coming back. So my basic question is that when FMCG companies are saying there's a pressure in demand, why is demand for a NBFC coming back?
So I think the way we look at it, I think we've talked about it in the past. There's clear differentiation probably between need-based product purchase versus aspirational product purchase. And, most of the financing that we do for vehicles, tractors, pre-owned vehicle, etc., they are the real livelihood product for them. They earn out of those products. And there's a lot of work that they are seeing. The tourism has begun, infrastructure has opened up, schools have started, people movement is at its best. So therefore, there is a need for these vehicles and tractors, both at the farm and the contracting segment. And that is what is driving, and that drives the cash flow, and the reflection of that is seen in our collections. So I would think, that's the way one need to look at it. As to what is the priority for rural at this stage, I think after 2 years of hard pressure, since work has come back, they are all very excited, very positive. Sentiments from our side, as we see, is very, very positive.
Okay, Ramesh, so that's the word coming in of how the demand sentiment is on the ground. But how's the overall vehicle financing, working out for you? In the month of May, we had seen very strong disbursements. June is ending as we speak. Could you share with us what has been the month of June?
So, though I can't put an exact number, but clearly June has been very, very positive. As all of us know, inventory availability is one of the issues. Tractor was a good bounce back we saw the last 2 months also. So clearly we see that the volumes are picking up, and we had also reported last 2 months numbers. Our assets are growing. So again, I would continue to say the sentiments are positive. Demand continues to be good, but truly comparing it with previous year may not be the real number to compare. It may look a very, very high growth percentage. But even if you were to look at it from pre-COVID times, I think we are very happy with the growth trajectory.
Okay, happy with the growth trajectory, but also wanted to get a sense from you as far as the collections are concerned. How is that trending? We had seen a number of almost 95% in the last few months as well. Is that trending higher? And what's the number that you expect it to be, let's say, 12 months down the road?
So clearly, in this market, the happy news is when the business does well, the collection does well, because that's a real reflection of the cash flow overall improving. What we saw in April, May was something that we have never seen in any of the past April, Mays. I'm not even talking of just the last 2 years, but even before. Normally after March, the economic activity does slow down, the extreme climatic conditions pull down the activity. But because it was a bounce back that we are seeing, all the activities were at its best, and that's reflected in the overall collection as well as control of the NPAs. And we believe that's the trend even going forward very clearly.
When will the impact of interest rates start hurting consumer? 1%, 2%, 2.5%. When will it start reflecting on their ability or inability to pay back loans?
So clearly, unless the freight rates go up, unless the passenger fare goes up, I don't think the consumer can absorb this kind of a cost, both with fuel and the interest rate going up. So clearly, I would think the demand would start getting impacted if there were further increases in the rate, which all of us would pass on to the consumer. And if they can't pass it on through the freight or the passenger fare, I think the demand would start to get impacted.
Can I say that second half, or if not second half, maybe fourth quarter would be a tough quarter, because the real impact of interest rates will be felt. Demand, in a sense, still remains inelastic. So are you worried about NPAs coming back in early part of 2023?
NPA won't come back for a very simple reason, that you see the activity levels are very high. But will people want to add more assets? We also expect that the vehicle prices will also go up over the same period of time. My belief is that if this is the level of activity, surely the freight rates will go up and even the passenger fare will go up. So I would kind of repeat to say, if that does not happen, you're right, fourth quarter, because that's a time even, our borrowing cost will start to come in, because currently we are still running a good ALM match. Not all liabilities getting corrected. So the full cost of borrowing is not impacting the average cost of our funds. So therefore the need to pass on may not be there up to another 2 quarters also. But post that, if the rate increase continues to be, and if we have to borrow funds for future business and comes at a new rate, definitely the interest rates will start getting passed on. And that's the time the consumer will decide whether to add asset or otherwise. But from a collection side, I'm still very buoyant because the activity levels are very high. And these are all assets on which there is no additional interest for their fixed cost. Only the variable is the fuel price. And that would be absorbed because the volume of work is very high.
We've always quizzed you on spreads, demand, but today I'm going to phrase my next question slightly differently. We've got a large audience who also invest money in fixed deposits and especially corporate fixed deposits. Your paper needs no introduction in terms of endorsement because it is from the Mahindra Group. For somebody who's looking to invest, let's say, in a fixed deposit of Mahindra and Mahindra Financials, how do you see the trajectory moving? Do you see you increasing interest rates in fixed deposits in line with what RBI would do? Will always be higher than FD? I'm asking you this because now we get a lot of emails where everybody they're feeling the heat of high inflation and low FD returns. That's the time when corporate deposits will start growing.
So clearly the answer is yes. Deposit is one good source of money for us. And there will be a few basis point increases that will happen. And it will keep increasing if the overall borrowing cost keeps increasing. I don't think there is any doubt in our minds that the FD rates will also go up in line with the increases. But will it be exactly in line with the overall cost of borrowing? May not be. Maybe to start with, it may be a 15-20 basis point increase. But if the rate were to continue to increase and it goes up to 200 basis point over the next 2-3 quarters total, I think the deposit rates may look to be 0.5% at least higher.
Okay. Ramesh, there is this one question which I've always had in my mind, and I've had the pleasure of interacting with you for almost 15 years now, is that why is that Mahindra Financial has not been able to build such a formidable retail franchise, which all of us have been we've all have spoken about this, and what are you planning to do to address that?
So clearly, if you look at our reach, that's not any short, right? We have 1,300 branches. We are adding more branches. We are moving deeper. We are now investing in technology to be even digitally able to penetrate and make the services available. I think what we have done so far was we've stuck to one product line, which is largely the vehicle and tractor family business, right? That's been our overall business family in which we have been. We are opening it up. As you see, our digital FinCo, we have gone into small ticket loans, consumer durable loans, etc. And that's a need of that market out there clearly. We have opened up our SME financing, which we got in a couple of years back, but we went slow as the pressure on the market was high. We are kind of coming back on that front. The loan against property in the semi-urban rural market is picking up. A lot of suppliers, dealers, traders want to pledge their property to take some working capital loan. So you'll see a very different approach from us in the next 3 years, and we have put it out very clearly as to how and why we want to double our balance sheet and where is it all coming from. And that's where you will see the entire benefit of this franchise and the deeper penetration that we have made.
Okay, Mr. Iyer, thank you so much for joining us live today on this show. Great to have your views so candidly, and that's what M&M Finance is also going to be doing to build a great retail franchise.